You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, Hamish Hodder, my friend. We have, 53 minutes before the cricket starts. So
yep, it's going to be a 52-minute podcast today, everybody, because we're 7 minutes late and we want to watch the cricket.
How you going, mate?
Yeah, I'm doing pretty well. Yeah, just cruising along. Yeah, how are you doing?
Cruising along?
Yeah.
Yeah, I'm busy at the moment, just getting everything sorted. I think I'm gonna get set up in the new office, hit the ground running next year. So I think I'll be in there literally at the very beginning of next year. I've got my video editor. I think I said that last week. Getting everything sorted. Man, having an employee is difficult. There's so many things you got to work out. I mean, I've got to get up to speed on like proper accounting software, make sure that's all good. Got to keep track of leave and all that. I'm just hoping that the accounting software does that for me. Got to pay people. You got to get like workers' compensation insurance and different insurances, public liability, this sort of stuff, that sort of stuff. So it's just it'll be good. It'll be good because it'll give me my time back, but just to get it set up, it's just, if you've never done it before, it's quite difficult, really.
Yeah, I mean, you're doing it at a really busy time of the year as well. Yeah. I mean, God, December is just always crazy. I mean, obviously there's like the whole Christmas thing. There's all these events going on. You're meeting up with family and your friends, and you got to get presents for everyone. And then, work, you kind of, well, at least for us, we kind of get to the end of the year and we're like, crap, we've got to cram in 4 or 5 weeks of work into 3 weeks so that we can take a little break.
Yeah, exactly.
It's always a chaotic time, but it's kind of nice at the same time. You get to be really busy for like 2, 3, 4 weeks leading up to Christmas, and then you can just take a nice little bit of a break. At least that's what I try and do.
Yeah,
every year.
Nah, I'm the same. There'd be nothing worse than sitting there on watching the Boxing Day test and going, "Oh crap, I got to make a video."
Yeah.
I think everyone needs a little bit of downtime. It's hard with YouTube because there's never, like, if you're not online, then YouTube's got no mercy. They're like, all right, you're not online. So we kind of have to continue, but yeah, it just means we have to work really hard over the next couple of weeks. So yeah, that's something I need to do as well, is I need to try and get ahead. Q&As. We'll just have to do Q&A videos.
Yeah. Some
that's the answer.
Yeah, some little low work videos.
Yeah. And for those that don't know, little look behind the curtain, Q&A videos for YouTubers, they're like, if you got nothing to talk about or if you're really pushed for time, just do a Q&A video because you can smash one of those out in a couple of hours.
Don't reveal all the secrets.
But no, they're still good. I mean, they're still good videos because you get to directly answer what people are interested in.
I actually really enjoy doing Q&As. They are, I don't know. Yeah, you're right. You get to kind of
gives you good connection.
Yeah, you get some direct feedback from the audience about, you get some ideas about what videos they want to see and what questions they have, and you can kind of, it brings it a little bit more personal for a video. So yeah, they are good.
Yeah. All right, let's get stuck into it, mate. We've got 50 minutes. I'm looking at that clock now. We're not actually going to stop for the cricket. But what are we talking about? Debt ceiling is raised again. Something about that. I've got an interesting update on Didi. Didi's getting delisted. It's a Chinese ride-hailing app getting delisted in the States. So you can imagine the kind of news that's causing at the moment. We got a Ray Dalio interview, and we also have a Mohnish Pabrai interview, which actually it was a really good interview. Very well done by the interviewer to structure it. I'll talk about that later. But that's what we got in this podcast. So let's get cracking, eh?
Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, and you can connect to almost any broker now, or you can do it manually through Excel or just manually enter in each trade. And once you do that, it will track all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used to track performance, diversification, that sort of thing, as well as used at tax time to track things such as your capital gains, dividend income, and more. And at the moment, you can try Sharesight completely for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, track up to 10 holdings for free forever. Or you can also use that link if you want to sign up to a paid plan, and you can get 4 months off a yearly subscription if you use our link. So go check it out. Particularly, I guess, if tax time is upon you, then now's a good time to get your tax affairs in order using something like Sharesight. And thanks everyone who has used that link and is supporting the podcast.
All right, where are we? Can we start with this debt ceiling stuff?
Okay. Yeah.
Because what's been going on? We were talking about it a few weeks ago because it was all over the news at the time. I guess the US government, they're raising a lot of debt. They're doing a lot of stuff. They're spending a lot of money, and they hit that debt ceiling. And there was a period of time where it created very extravagant news headlines, where it was going to say that the US was going to default on their debt, which is just like, if that actually happened, what the heck? That would just be the most bonkers thing ever. But now there's been a bit of an update. What are they looking to do?
Yeah, so I'll give a little bit of a brief background of kind of what's happened so far, just to catch people up to speed, because there's kind of been a lot of events that have kind of taken place over the past year. But what the debt ceiling is in the first place is the US has a limit on how much money that it's allowed, how much debt it's allowed to borrow. So that's kind of just a mechanism of law that if they want to raise that ceiling, if they want to borrow more money above the ceiling, they need to go through Congress, right? So it needs to pass through law. Why do they constantly need to raise the ceiling? Like, I think the ceiling's been raised, every few years for an extremely long period of time. Well, they need to do that because they need to get new debt to pay off the old debt. They're like someone who has too many credit cards, right? They just they instead of just getting more income, instead of increasing tax revenue or cutting back on spending, they just get a new credit card and they just pay off the old credit card and they just kick the can down the road. But exactly. And just quickly, I'm just having a look at it. The US national debt is currently at $29 trillion. Just a little bit, just a smidge.
For those that are wondering how much debt we're talking about here, $29 trillion.
Yeah, and of course with inflation, that number's naturally going to go up over time. Like, you would never expect that number to go down below what it was, 50 years ago, for example. But it also has been going up significantly because the actual amount of debt above, just a natural increase of inflation, has been quite significant. And they need to also raise the debt ceiling because if they can't pay their old debt, if they can't make payments on what are treasury bonds, right, government bonds, then they'll default on those bonds. And we always talk about how we basically call those bonds risk-free because the US government has never defaulted on those bonds. So they're considered kind of the risk-free yardstick that people can compare investments to. So that's kind of the background for the debt ceiling. Then this year in August 2021, that limit was exceeded. So they peaked at how much debt they can take on, and they were actually running since August on just the leftover cash that they have. So they weren't actually able to take on more debt since August of this year. Then in October, they ran out of cash. So they got to the end of that and they had to scramble. And we spoke about this a few podcast episodes back in October about how they had to scramble to try and raise the debt ceiling. They couldn't raise the debt ceiling. Back then, they couldn't reach an agreement with Republicans. They needed Republican support. So they passed a temporary extension bill to prevent the default. So Republicans, essentially, their position is they don't want to raise the debt ceiling. They don't want to just allow Democrats to do it, but they also don't want to default. They don't want the US to default. So they'll allow these kind of extensions and little loopholes that allow them to push things a little bit along further. And that's what happened in October. And that did delay the need to pass the debt ceiling bill. But it only delays it until December 15, which is in 6 days. So they've run out of time again. That's kind of where we're at in terms of what's going to happen over the next week. And of course, again, we're getting the mad scramble to get that
sorted
bill
out.
passed. So that leads us to where we are today. So the House of Representatives took the first steps on Tuesday to prevent a possible default on US debt. So the House of Reps, which I believe is controlled by the Democrats, they passed a bill allowing the borrowing limit to pass with a simple majority. So what they're doing is typically when you need to pass the debt ceiling, and I'm not sure if this applies to all money laws or if it's just the debt ceiling one, but you need a 2/3 majority in the Senate, which means they need a lot of Republican support. So they're trying to do a little loophole here where they first pass a bill that says we can pass the debt ceiling with just a majority. So just with 51%, for example, or 50 and one vote. And then they can try and pass that. So they're trying to do it in like stepping stones, in like 2 steps, because they can't get it through with 2/3 majority. And they can try and get through this first part and negotiate with Republicans on that and then get it through easily on the second one.
Right.
So that's where we're at right now. And the bill that they're trying to pass now, which is that stepping stone, they need the support of 10 Republican votes. And then if that does pass, then they will be able to pass the debt ceiling increase with no Republican support. So this is kind of the necessary step to get Republican support a little bit, 10 votes, and then they can do whatever they want with the debt ceiling. So that's what's going on at the moment. I think Democrats said that they're confident that they have the votes. So obviously they don't just go blindly into these things. They negotiate and they talk to individual senators, and a senator says, well, I want you to put this in the bill. I want you to increase my pay. No, they don't do that. But they negotiate with things that their
Free
party
box of
want.
cookies.
And then they say, yes, I'll vote with you. So they are confident that they've got the 10 votes, but we will see, I guess, what happens. I think that's going to happen later this week. So
what are your thoughts on this? I feel like, I don't know, when it comes to something like a debt ceiling, how much debt the country's in, kind of sounds like something that maybe you do want to have a super majority on to really make sure everybody's on board. Because I feel like with a simple majority, I don't know. You just think about what puts companies at risk. I guess you can think of the government as like the world's biggest company, I guess, but it's like companies are their risk of bankruptcy goes up with the more debt that they have.
Yeah.
So I just wonder, is something like how much debt a country is able to take on something that you just want a simple majority? Or do you want there to be a super majority where both sides of the coin have to really say, you know, this is the right thing to do? I don't really know. What's your thoughts?
Yeah, I think it's certainly something. It's one of those things that you want to be considered very deeply. And I probably agree with you that it kind of makes sense that you try and get a 2/3 majority, that you need both sides of the aisle to come together. But then, I mean, the alternative to that is that, you have one party that if they do have control of the Senate, or even if they don't, like Republicans, I don't think they have control of the Senate. They just have enough votes that 2/3 is not enough. If you have a situation like that, they can use it as leverage to get things done that they want. And, Republicans are not the majority at the moment, right? They're not in government either. So, it creates an interesting situation where they can kind of use it as leverage to get things done when they don't have the votes to get it done, if that makes sense. So I don't know. It creates an interesting situation. I don't think the US is going to default, but yeah, it's never happened. So everyone's kind of a little bit frazzled. I think that if it happens, I don't think anyone knows what would happen next. Would people immediately distrust the US dollar? Would people no longer trust US government bonds? Would they have a much harder time raising debt from that point? Would interest rates then have to go up massively in order to attract investors into the US? I don't know what would happen. I don't think anybody knows. And I think everyone's kind of just freaked out by the idea that the one thing in finance that we thought was a certainty might not be a certainty.
Yeah.
But like this is one thing we hold on to. We know stocks are risky. We know properties are risky. We know crypto is risky. But the US government bond, we can always go there, and our money is safe.
It's called the risk-free rate, the risk-free return.
Yeah, it's an interesting situation. But again, we'll see what happens next week. But yeah, I'm not an expert in this area. I don't know if there's other options of like, you know, if this doesn't pass, for example, will they default, or is there a backup option? Can they do another temporary bill like they did last time? I don't really know. I'm not an expert, so we'll just have to.
We're not into politics that much.
Yeah, yeah, exactly right. So we'll see what happens. We'll see if Republicans are able to push their weight around and get some things done that they want, and yeah, we'll check back in. Well, next week we'll know. Next week, either either you know there'll be an extension, or the debt ceiling will pass, or this bill will pass, and we'll know it's good, or everything might be in chaos. So.
The US will be on fire. Markets tank 50%. All of the nice short-term cash and treasuries are just being burnt up. Corporate balance sheets just out the window. Yeah, interesting. All right. With that said, should I talk about this Didi delisting? Delisting.
Yeah, it's a mouthful. I've heard a little bit about this, but not a huge amount. So I'm curious to hear what's going on.
Yeah. So people freaking out, right? So Didi is this Chinese ride-sharing apps like Uber of China. It's listed on the New York Stock Exchange. And they IPO'd not even that long ago. I think it was
probably last year or earlier this year.
I think it was earlier this year, actually. Anyway, long story short, they've been asked by the Chinese government to delist from the exchange by the first half of 2022.
Whoa!
So this is interesting because I've been talking. I can't remember if we spoke about this much on the podcast, but I've spoken about it on my channel. There's a lot of concern right now that a lot of these US listed Chinese stocks are going to potentially be delisted. You know, crackdowns by the CCP pulling them back to China. That sort of stuff. And this is the first time that we've really seen, you know, the Chinese government say, hey, guess what? You're coming back. We're not letting you stay listed over in America. So this has naturally sparked a lot of fear in investors for all these other US listed Chinese stocks. So we're talking like Alibaba, Pinduoduo, Baidu, JD.com. Like Alibaba tanked 8.2% on this news. Right. Pinduoduo tanked 8.2 as well. Baidu 7.8%. JD 7.7%. So there's a lot of fear right now. However, I decided I'd kind of look into this, try and get to the bottom of it. And I do not believe that the Chinese government actually wants to delist US listed Chinese stocks. I don't believe that's their intention. I'll talk about why in a minute. I actually think this is the Chinese government cracking down on Didi because Didi just pissed them off. So let me tell you what happened. Essentially, the long story short, Didi IPO'd on the New York Stock Exchange against the wishes of the Chinese government, which is obviously not a great thing to do. That's not smart.
Yeah, they used some kind of loophole, didn't they? There was a loophole in the legislation that allowed them to get on the New York Stock Exchange, and I think this week they closed. I don't know if I'm jumping ahead of your story, but they closed that loophole, I think, earlier this week or something like that.
Yeah, I'm not exactly sure how they did it, but yeah, you're right. The Chinese government is now working to close some loopholes. But the article just reads here: Didi pushed ahead with a 4.4 billion US IPO, despite being asked to put it on hold while Chinese officials reviewed its data practices. So, I mean, fair enough. They want to review the data practices. But Didi, effectively, they just blindsided the Chinese regulators. Right. The Chinese regulators then launched a big data security review. They pulled Didi products from Chinese app stores. And yeah, what you were saying, they even began an overhaul of the framework for international listings by Chinese companies. So Didi just like poked the bear. They just really pissed them off, which is just not smart. But then what's interesting is that I think this is last week, Bloomberg comes out and they report that this is going to be the end for US listed Chinese businesses. China's going to delist them all under this new framework. They were saying that the end has come. If you're an investor, you're going to lose all your money. They're going to get restructured. They're going to get delisted. Bad luck. You lost. And that news has really just amplified this whole situation. But the weird thing about this Bloomberg article is that there's no sources. How we laugh about this all the time. It was a classic case of people familiar with the matter.
Yeah.
Yeah. So there's no sources. It's literally like Bloomberg's just saying, "Nah, this is what's going to happen. Bad luck, guys," without actually quoting anything that anyone has said. But this news story then prompted the China Securities Regulatory Commission to release a statement on their intentions and what's going on. And they said relevant authorities in China have always been open to and fully respect Chinese companies' independent choices of overseas listing venues in compliance with relevant laws and regulations. Some foreign media outlets recent reports that Chinese regulators will ban overseas listings of companies with the VIE structure and demand that Chinese companies delist from the US stock exchanges are a complete misunderstanding and misinterpretation. So there you go.
According to people familiar with the matter.
Yeah. No, that actually was out of the China Securities Regulatory Commission. So that was not according to people familiar with the matter.
Yeah. Well, that's really funny. I mean, yeah, I think there's just a lot of articles and stuff going around of people who clearly have no idea kind of what's going on, or maybe they do, and it's kind of the case of it makes a good headline. It's an exciting. Is it better to say that Didi annoyed regulators and is then now getting pulled back off the US market, or is it a better headline of Didi is the first of everyone? Which one sounds
Chinese stocks are doomed?
Yeah. Yeah, so it might just be a little bit of a case of a case of that. But yeah, interesting to see that they actually made a response, and I guess it just comes down to whether you think that they'll honor that statement or or whatever. But yeah, interesting.
Yeah, but I thought this was interesting. This is interesting, and as well, just looking at how much news affects the stock price. Like there was this news of the Didi delisting, and then what Bloomberg turned it into. And Alibaba, it got down to I think $112 per share.
Oh,
it wasn't that long ago.
112.
112. Yeah, it wasn't that long ago. We were talking about Alibaba being like 160, 170. But yeah, tanked all the way to 112. But as soon as they got that statement out from the China Securities Regulatory Commission, that actually their intention is not to delist every Chinese stock. It is actually just we want to leave them alone, but we just want, if you're going to IPO, we want you to do it in the right way when we've given you the tick of approval. As soon as they said that, Alibaba just bounced up. It's now up 12% in 3 days. So it's pretty interesting just how much this news can kind of have an impact on the market. But I thought this story was just interesting because I know a lot of people are interested. Like the whole value investing community is just super interested in Alibaba at the moment. Because yes, there are these unknowns, but you at the end of if you just take away all of the risks, you are looking at a really solid business that is very undervalued. So that's drawing a lot of attention. But then I guess value investors are trying to work through those risks and say, are they legitimate? Because of course, value investing, where we try and avoid permanent loss of capital. That's Warren Buffett's rule number one. So, that's what we've been trying to do. But I think this is an interesting insight into maybe what the Chinese government is thinking about this whole delisting issue. And there's the Holding Foreign Companies Accountable Act, which is a US law which was implemented after the Luckin Coffee scandal.
Yep. The accounting fraud or something, right?
Yeah, accounting fraud. And the act basically says that the US needs to inspect the auditors of the Chinese companies, and the CCP has essentially said no. We don't want to allow that. But they're actually they're working together at the moment. And this article actually did a really good had a quote from someone from the CSRC, I think, saying that China, there is a risk of delisting because of this law, but at the moment, talks are going well and they really don't want that to happen. So they're trying to work with the US to make sure that it doesn't happen. So they're trying to get around it. But it's an interesting case. There's a lot of, there's still some unknowns, and it's a classic kind of risk reward. Are you willing to take the risk for, the business you're buying and the valuation you're buying it at, that kind of thing? But,
yeah, exactly right. It's I can't believe that it went to $112 per share. That's insane. I remember, I think it was, it had already fallen a long way and it was down at like 180 or something. And I said to you, I'd put 1% of my portfolio in if it went below 100.
You did say that. Yeah, it's getting close.
It's really close. Might have to.
It's interesting though. Like if you actually went deep into this company, I think you would find that it really is quite cheap. Like I reckon you'd look at the e-commerce business and you'd have a look at the price now and you go, oh my gosh, this is insanely cheap. Yeah. And then you wouldn't, because at the moment cloud's going to be huge for them, but it's not at the moment. And they've got their 1/3 stake in Ant Financial as well, which is just a finance behemoth. And if you it's almost as though you're getting those for free, which is just, if you think that they're going to grow at all into the future or are worth anything, then the deal kind of just gets sweeter. But it shows you just how much these risks are weighing on the stock, which is always the way it goes, I guess.
Yeah, exactly. I think it's going to entirely come down to whether any of those risks actually materialize into anything. Because if they don't, then I mean, I think I personally haven't analyzed the business, but that's the consensus I get, is that it's, just looking at the business, if you imagined it was, I don't know, if you imagine if it was an American company, then, or just operating in America and China was completely out of it, then, then it looks, a lot of people are saying it looks very good on a valuation basis. I think it's at a 17 PE or something, which is crazy for a company if they go on to grow at 15, 20, 30% per year for the next few years.
I think they're growing at, they're going to grow at about 20% this year, I think. Right. But even if you do a DCF with like 10 to 15% growth each year, I mean, even then, personally, I found still quite a decent margin of safety. I think you'd find it interesting if you dived into it.
I had a look for some time, and I don't know. I think for me, the uncertainty around China is just too great for me. All
right, fair enough.
I will stand by my earlier statement that if it goes below 100, I will put 1% of my portfolio in it. And I thought that was a joke. Now it looks like I might have to. So
why not?
What is it going to go
that
down?
Could be a little spec stock. It's like a value spec play.
It's not even that. It wouldn't even be that far on the speculative side. Like it would be far less speculative than, say, like if I put 1% in, I don't know, some obscure cryptocurrency or something, for example.
Anyway, so that's Alibaba, Didi, Chinese stocks. That's the update. I actually made a video about it. It came out yesterday. But if you're interested in learning more, I think that will just about wrap us up. You want to talk about Ray Dalio?
Yeah, we haven't.
What's he been saying?
Yeah, I mean, I was about to say we haven't heard too much from him, but we haven't heard too much from him at length, I should say, for a while. He's done some short interviews with CNBC here and there.
He pops up, doesn't he?
Yeah, he pops up every now and then, and he's got a new book out, so he's doing the what do you call that?
He's on the media train.
He's on the media. Yeah, he's on he's going through and doing all the interviews and everything.
All the promotion.
Yes, exactly. So he did an interview with CNBC. Was the interview actually on Instagram, or because I
think it was.
It's on Instagram.
I was reading. I went to CNBC, the website, and they were talking about Ray Dalio's been saying all this stuff, and then I clicked on the article, and then it said in a interview with Ray Dalio recently, and it had a hyperlink. So I just clicked on the hyperlink, and it took me to Instagram.
Oh, okay. So it must.
So I think it was just an Instagram interview.
Yeah, I couldn't find it on YouTube. It's so strange for them to do something like that. I don't know. I guess they're trying to drive more people towards CNBC's Instagram pages, I guess.
Yeah, clearly.
I don't know. Very interesting. But yeah, he's doing his promo for his new book. His new book is Principles for Dealing with the Changing World Order and Why Nations Succeed and Fail. So, another book kind of looking back over the long history of in this case of the world and how different nations, navigate that with each other and within their countries. So, it should be, I'll probably take a look at it. He wrote it in a really interesting way. He wrote so basically each page has like a little kind of summary section that's in bold. And then there's like a deeper explanation that's kind of the rest of the book. So he describes it as 2 books in one. There's kind of the headlines, which is still like a lot. Like you will learn a lot just by reading the bold section. And it's kind of like a little book. Or you can dive into the nitty gritty, which he's got raw data and all of this stuff that's, really deep, really deep investigation and evidence of what he's talking about. So you can kind of read it. Yeah. And he kind of did a similar thing with his Debt Cycles book where at the start of the Debt Cycles book, he has a summary of all the major debt cycles over the past 150 years or something like that. And then the rest of the book was a detailed explanation of each. So you could just read the first section and get a good, overview understanding. And it's still quite long. I think it was like 100 pages or something. And then you could go on and read the rest of the book if you really want to nerd out on finance. So, so that's kind of how he structured the book. But I mean, he spoke about a lot of things in this interview. I'm not going to get through everything, or maybe I'll just summarize a couple of things. But he spoke about the book, and he spoke about the fact that there's kind of the big takeaway of the book is that there's these 3 major factors that are driving what we're seeing in the United States right now. And I mean, really what we're seeing in the global economy right now. He sees there being a financial factor, an internal conflict factor within the US, and then an external conflict factor, which is between the US and other nations. So the finance factor is that we've got this low interest rate environment. As a result, people, governments, businesses all have a lot of debt. And now we're in a situation where we need to pay for that debt. We're reaching the end of that debt cycle. We're reaching the upper limit of how much debt the government can take on, literally in terms of the debt ceiling.
Yeah. We're just talking about it.
So we're reaching a point, and then we had the pandemic where the revenue the government was generating collapsed, for example, and there was a massive need for even more spending. So that kind of exacerbated the situation. So to pay for all of that, because we're at the upper limit of debt, we have to print a lot of money. So that's what governments are doing at the moment. The US government, what are they printing? $120 billion a month at the moment. They're going to be trying to reduce that down, but they've been doing that since I think March of last year. So that's if you run the maths on that, that's 18 months of 120 billion a month. It's a lot of money that they've just added to the money supply, basically. And all of that devalues the dollar. So that's kind of the first factor, that's the finance background of what we're seeing right now. Maxed out debt, printing of money, devaluing of the US dollar. Then the second factor is the internal conflict. So within the US, they actually are facing the greatest political gap between progressives and conservatives since 1900, which is kind of astounding. But it also, I don't know, I kind of felt you could kind of feel that's true. You can, yeah. But even over the last like 5 years, things are really ramping up. More people are interested in politics or talking and have political views than ever before. It's kind of crazy. I mean, how many people have really strong political views. And I think when you say, there's this wide gap between progressives and conservatives, you might wonder, like, how do you even measure that? Is that just subjective? But there's actually ways you can measure it. One that he talks about in the book is tracking what percentage of votes in Congress are done along party lines. So what percentage of the time do Republicans vote with Republicans versus, switching over? Like we spoke about the debt ceiling earlier. They need 10 Republicans to vote with Democrats. So like in the 1980s, for example, that number was 85%. Today, it's 96%. So 96% of the time, Democrats, for example, 96% of the time Democrats will vote with Democrats, and Republicans will vote with Republicans. So there's basically very little movement between the two parties, and that's kind of a demonstration of the fact that the two parties have very, very different views now compared to, like, I don't know, I think the lowest it was in like the 50s or 60s, where the parties were still different, but there was quite a lot of overlap. So you had Republicans voting for Democrats and Democrats voting with Republicans, and kind of going back and forth a little bit. So that's an interesting kind of aspect of what's going on. And then the third was the external conflict. So that's the rise of a great power, which in this case is China, to challenge the existing power, which is the US. So he talks about how China is 4 times the population of the US. So over time, it's very likely that they will become stronger and more powerful than the US. Those are kind of like the 3 key factors, the backdrop of what we're seeing at the moment. It was pretty funny in the interview. The interviewer was, after he went on a spiel and explained that, she was like, "I'm very, very worried now."
It does sound a little bit like you chuck all 3 together and you've just got total chaos. Ray is I think he's very concerned about what we're seeing right now. And he's always kind of been the one, like, he's always been a bear, right? He's the kind of person who's always kind of letting people know when things are getting overheated and when things are looking concerning. So, that's his position where he is. So you got to take it with what that is. But he also sees that the most recent time we've seen these 3 factors really boil up and create a lot of risk was the 1930, 1940 era. So you had the US coming out of the Great Depression, which was the finance kind of factor there. The changing of their monetary system. There was also large political gaps, so that was their internal conflict. And then there was the rising power of Japan, which was the external conflict. And when he talks about things like that, for example, which of course we all know how that ended with World War II. So when you hear Ray talk about these things, I think it does kind of make you concerned about what's going on right now. But it's also interesting to hear what he says, because he knows a lot about this sort of stuff, and he's been studying it deeply. But he spoke about some things that are also not kind of that scary. He spoke about his investment in Bitcoin. It was very quick. He just said he uses it for diversification. So just kind of reiterating that. He spoke about the importance of meditation, which I thought was interesting. He's a big advocate of doing daily meditation. I think he said he meditates twice a day. He's a big advocate for that. And then he spoke about the importance of charity as well. And I think this kind of feeds into his thesis of how he sees the world. And I kind of actually agree with him on this. So Dalio, of course, is a big capitalist, right? He's very in favor of a free market where people can, have voluntary transactions between each other, and where capital can be allocated to people who have ideas but don't have the capital, right? So that they can create value for people. So he's a big advocate of that, but also recognizes that in a system like that, you get massive disparity over time, right? If you in a system like that, people who have assets, it's easier for those people to get more assets by making investments and outlaying capital and getting more back. And what that means is there's this disparity between people who have assets and people who don't. And I think it's important to recognize, and his kind of, I think his kind of main solution to that is trying to drive an increased culture of giving back if you can. Which is what he's a big advocate of, and I certainly agree with that. I think that I like capitalism. I think it's a good system, but it's not perfect, and I think that there's definitely a need, either forcefully through the government or voluntarily. I think ideally by individuals who have excess capital or wealth, voluntarily doing research into ways that they can help people at the other end of the spectrum. So that was kind of what he spoke about right at the end, and I thought it was a nice kind of it was a nice finish to his very scary talk. That's a very interesting point. I do agree. I kind of get annoyed because I just see it even in with my friends, when friends talk about politics. It's just, they're so, I don't know. Or when we talk about, who'd you vote for in the last election, people are like so on one side of the coin. And I guess this goes back to what you were talking about, how, how there's such a political gap right now. It's like people love to cling. It's like they're on a team.
Yeah, it's like tribal.
It really is. It's just like, there'll be the people that say, no, capitalism, everything. Capitalism is the way to go.
Yeah.
But if you look at it in reality, it's not, you don't want 100%, you don't want pure capitalism, because things will just fall to, people will get screwed.
Yeah. Imagine if we just
and
had
that's
imagine if we just had a full anarchy system where there was just no rules, free market, regardless of it would just be chaos. I mean, the first thing my mind immediately goes to with that is environmental laws. I mean, if there's no restrictions on this basic example, dumping in the lake, businesses are going to do it because, not all of them, but there will be businesses which do, because it makes more money. It's cheaper.
Yeah, they're on the brink. They need to get rid of their trash. They can't pay for waste disposal. Dump it in the lake.
Yeah, obviously you can't have complete anarchy or just a complete pure that would just be insane. And you would have these crazy powerful businesses that you just don't want that. But yeah. Sorry to interrupt you.
The one that gets no. I was going to give another example. The one that gets me is people are just I agree generally with the idea of, you go out there and, make a life for yourself. You work for yourself, work for someone else, earn your own money and make your own way. But, or there would be some people that they're but, I believe that if you get really successful, you should have most of your money taken off of you and given to the people that don't have as much. But I kind of agree with both. It's if we had just the pure capitalistic approach, then I work with a young fellow with Down syndrome, and man, if he was just left out in society and had to try and just do it all himself, he would struggle so much.
Yeah.
So I'm of course we need to have elements of both. We need to have some sort of, as Warren Buffett says, he's let's have a generally capitalistic approach, but we need some social safety nets, because otherwise people will get destroyed. But I find it very strange that there's people are just clean. There's they're on a team. It's us versus them. But when people say, do you vote, Labor or Liberal? I say, well, I don't really vote either way. I kind of look at what both parties have to offer, and then I make a decision on what I think will be best. And generally you find that your values and ideas, political opinions kind of do end up aligning with one side. But I never take the approach that, I am a Labor voter or I am a Liberal voter. It's just a case-by-case basis. I mean, surely you have to keep an open mind.
Yeah, I mean, it would be it would be a little bit weird if every single one of the decisions that say the Liberal Party made, that you agreed with every single decision. That would just be, I don't know. If that's the case, surely you have to think, maybe I just think that I agree with those things, but I don't actually, I haven't actually thought about the issue. You would think that, we're all different human beings. So, I mean, I know personally, when I think deeply about certain issues, I have some views that fall, more progressive, and some that fall more conservative. And that's, I've kind of find myself having a mix of both, and maybe I lean a little bit more to one side, but I certainly don't 100% subscribe to one side. So yeah, and I think when you're, when you're picking to vote for somebody, there's always going to be a couple of major issues that are at the forefront right now, right? There might be maybe it's climate change or something like that. And so you're going to be focused on that specific issue and which party does the best job in your opinion, from what you want to see. That doesn't necessarily mean you agree with that party on other issues that are not currently being discussed. It would just be insane if you just, well, I mean, some people, maybe it's not. Maybe that's okay. Maybe some people just do completely subscribe with one side. But I don't know. I don't know. It is interesting.
It is interesting. But I like what Ray says. If you have a lot of money, then it's probably nice. If you're a nice person, you probably realize that you don't need all that money and you give it away.
Yeah. Yeah. He was.
Give it to charity.
Yeah. He's doing an event where he's giving 20,000 people $50 each to donate to a charity. And like his kind of mindset behind this is he wants more people to go through the practice of doing a little bit of research, finding something that they believe in, finding a charity they believe in, and actually going through the process of click, 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 giving some money away, because he wants to encourage a culture where that's just the normal, where like if you have, you get to the end of the year, you're sorting out your tax or whatever, and you realize, you know what, if this is you, you're like, oh, I'm actually doing quite well this year. I'm gonna give back. That's a culture that he wants to drive more of, and I completely agree with that. I think that more people could do that, and the world would be a little bit of a better place.
Yeah, definitely. All right, good one, Ray. That was good. Man, that turned into quite the discussion, didn't it?
Yeah, sorry about that. I said I wasn't going to do it.
No, that's good.
Said I wasn't going to go on a monologue, and I did.
That's all good. No, we had good discussion there. It's an interesting topic. But with that said, I'll talk about Mohnish Pabrai a little bit. I love listening to Mohnish Pabrai. Mohnish Pabrai, when he speaks, it just clicks with me. I don't know. There are some people that I find hard to listen to. Ray Dalio, sometimes I find hard to listen to because he can get a little bit complicated quite quickly, or kind of brush over the basics and just go straight to the in-depth kind of stuff. And I'm like, wait, what? Mohnish Pabrai, whenever he talks, I get what he's talking about, which is, I really like it. But this interview was particularly good. It's by a young fellow, actually, and he did a really good job because the way he structured the interview was that he went through the value investing process. So he started asking him about things like, okay, how do you find stocks? And then he went on, how do you assess the moat? And how do you assess the management team? And then he finished off asking, how do you value the shares? So I was just like, oh, yes, dude, you've just broken down the strategy and actually really gotten some cool information. So I'll kind of just give a bit of a summary. So we'll just start at the top and work our way down, I guess. So he was asked about, what's your process? What's your process in finding stocks? And Mohnish says that for him, he really just he follows his curiosities. So, for example, he reads a few digital newspapers. He goes out and he talks to people. He's in a bit of a different position to most of us, where he can talk to management team of large companies and that sort of thing. He's essentially what he's trying to do. He's just trying to absorb. He's trying to be a sponge on things that he's interested about, and he's just trying to find an aha moment, some sort of aha insight that most other people don't appreciate, that gives you an edge. So I thought that was interesting, and that's pretty much how he goes about trying to find his stocks, because his stocks can be quite varied in the different industries that he kind of follows. Sorry, you guys.
I was going to say, his portfolio is wild, especially if you look at it over time. Like I don't know, like I think he just because he goes into a lot of areas I wouldn't. He's in property, and then he has his Turkish business, and then he was in micro.
Yeah.
Like, to me, I just look at that and I think, oh my God, I would not touch any of these areas just because I don't personally understand them. So yeah, interesting to see that.
Damn it, Dave Warner just got out. Oh, well. Anyway, so that's his process. Then he got asked about circle of competence, and he said, look, honestly, the best way to kind of stick within your circle of competence is just look at the products and services you use regularly. I think that's a really good rule, and it's one that I use myself. So he's talking about, what phone do you use? What clothing brands do you like? That sort of thing. Just what do you bump into every day? Don't go searching, because if you start searching, you kind of end up outside your circle of competence.
Yeah.
What else did he talk about? He talked about watching out for leverage. That was pretty obvious. He talked about it personally, like don't take on margin, don't trade options, that kind of stuff. He was talking about interesting. One point that he said is that he can actually find, and maybe this is not for everybody, but he can actually find there are some really good investments that do rely on leverage that have quite a lot of debt, because sometimes the presence of leverage can scare others away, or can scare a lot of investors away, which can, if you can understand it, can actually create good investment opportunities, because it's a stock that's unloved because of how geared it is, how levered it is, which I thought was interesting. But honestly, for most people, especially for us that are not like super like, well, you're probably different to me, Hamish, but for me, where I'm not like, I can't just read an annual report and know everything straight off the bat.
I'm not like that.
Maybe it's maybe it's something that general people should avoid, is just stay away from companies with leverage.
Yeah, well, I think that, I mean, that's just a field of expertise in of itself, assessing debts and whether businesses can cover them. So yeah, that is certainly something I am no expert in, and I just fall into the same category of a lot of investors, which is it's super easy to avoid that massive risk by just investing in companies that don't have any debt, because it is a really big risk, and it's one of those things that if you get it wrong, if you try to invest in businesses with debt and you get it wrong, it'll be could end in the business being completely wiped out. So yeah.
He got asked about rate rises, what he thinks about rate rises. He basically just said, just watch out for companies that are highly levered, where a lot of their earnings right now is taken up by interest payments, because if rates go up, obviously they need to pay more interest. So he basically just said debt, adds that layer of bankruptcy risk. So just watch out for companies where a lot of their earnings are already chewed up by repaying debt. Then he got asked about the moat. So he said moat usually becomes obvious if you actually use the products or services yourself. You can actually spot the moats quite easily. And one thing that I kind of found interesting is that he said, if it's not a no-brainer, then they don't have a moat. I think that's kind of smart, because moats really should stand out. But he also says, oftentimes you can see a moat in the numbers. So he says sometimes it's a no-brainer when you look at the numbers, but sometimes you actually have to reverse engineer the numbers to figure out what the to be able to describe what the moat is. The reason why they have a competitive advantage might be hidden. But he basically said, look, for moats, yes, you definitely need a moat, but it needs to be a no-brainer. If you can't look at the numbers, or if you can't look at the business and go, of course that's why they have a moat, then they probably don't have a moat.
Yeah. And I mean, that makes perfect sense. I mean, I think what he said about how like oftentimes you can see it in the numbers, I think it makes sense. I mean, if a business does have something so powerful, so unique that, regardless of the circumstance, pandemic gets thrown at you, customers still come back, and in higher numbers. They're still telling their friends and family, and those people are coming back next year and buying the product or using the service. If that's the case, then it's going to be in the numbers. You're going to see it in powerful compounding growth and high return on invested capital. So it makes sense that that's the case. But then, I think sometimes it depends on the nature of the moat. It could be hidden. Like, I think a scaled economies shared is a good example of that, where if you just look at the gross margins or the profit margins for the business, Costco's profit margins are terrible. But it's in that, you have to kind of read between the lines with that one. It's not because they're inefficient, not because they have high expenses. It's because as their expenses go down, they reduce their revenue. They reduce prices for people. They sacrifice revenue, which gives them low profit margins, but means that the end customer is getting a really, really good deal. And that is powerful. So,
gives them a fat moat. Exactly.
Yeah.
Yep. So that was moat. In terms of management, he was asked, how do you evaluate management? And he said, just look at their track record. He said, don't look at projections. Don't look at what they're promising, because they could promise the world. Just forget about what they're promising. Look at what they've done in the past and evaluate for yourself. Did they overpromise, underdeliver? Did they do the opposite? Just have a look at what they said they would do in the past. Did they get it done? How effective have they been? Look backwards in this case. Don't look at what they're saying it will be, which I think is a very smart thing to do.
Oh yeah. That's the cardinal sin that I just see so many people make is they find these IPO companies. So many people do this, even on YouTube. People are talking about these
2026 revenue projections.
Oh my goodness. And like, it's a company you've got financials for maybe a quarter, 2 quarters, or like a year maybe, or something like that. And the entire thesis is based on usually, maybe not always, but usually around a presentation that management does to get people to invest at IPO because they need money, where they make projections about where the company's going over the next 5 years. But there's just no track record to know whether that's even possible or reasonable. Big mistake that a lot of people make. I think I personally do like using management's projections, but the big caveat to that is like I've first made sure that they have a long 10, 20, usually even longer track record of making projections that are reasonable and constantly not, giving these audacious goals that they never hit, or they just make a goal and then a couple of years later, because they're not going to hit it, they just forget about it. I think Thor Industries is a really good example. They always set 5-year goals, and they've been doing it for 30 years, and they always set extremely reasonable goals. So then when they project, now I'm like, okay, I feel like they're not going to be unreasonable in their projections.
Honestly, as an investor, you probably prefer a little bit of sandbagging. You probably prefer them to take it's best for them. They want to try and say, no, we're going to do all this amazing stuff, but it's probably better for you, the investor, if they do sandbag it and they tell you that they're going to do less, or they think that they'll come in slightly less than what they actually believe they'll do. Because it gives you a really good understanding. It makes you as the investor think very conservatively as well, so that then if you do your valuations and stuff and it still comes out looking good, then you can feel quite comfortable there. And speaking of valuations, this is very interesting. Something that might as soon as I heard this, I was like, oh, I don't know if I agree with that. But then as he explained it, I definitely agree with it. He was saying when it comes to intrinsic value, you actually don't need to be super precise. When I heard that, I was like, wait, what? Man, I do all these calculations. I've got my spreadsheets out. And he pretty much said the reason for that is that when you're looking at companies that you want to invest in, when you look at the valuation, it has to be a no-brainer. For example, he says, if Coke is, let's say Coke is worth more than 15 times trailing earnings. If Coke is offered to you at 5 times trailing earnings, it's a no-brainer. But if it's offered to you at 12 or 13 times trailing earnings, then you don't really know. So he would say, in terms of intrinsic value, it just has to hit you. You have to just look at it and just be like, oh, this is obvious. And I guess when I thought about it more, what he's really describing is just the principle of margin of safety, right? Because that's the whole reason we take like 30 or 50% margin of safety. If we hit a 50% margin of safety, then that's like Mohnish saying, that's a no-brainer. If you've got a big fat moat, if you've got a great management team and the company's growing like crazy, you do a valuation at a fairly conservative growth rate and you get a 50% margin of safety, that's a no-brainer. So that at first I was like, wait, what are you talking about? You don't want to be precise. But then as he explained it, I was like, actually, it's just explaining what we already do.
Yeah, exactly. You do spend a deep amount of time thinking about where you think the business can be in the future, recognizing that you're not going to be able to specifically calculate where they'll be. You come up with a range or a reasonable idea of where they'll be, and then you deduct 50%. And if you get there or even around there, it doesn't have to be, you don't just run a calculation and then deduct 50% and then that's the number you have to buy at. If it gets anywhere near that number, you know that you're getting, a dollar bill for around 50 cents. So even if that dollar is actually 80 cents, if you pay 50, then you're still good. Still good to go. So very interesting.
So I thought that was a pretty cool interview. Very well structured. So props to the interviewer there, because he really just made Mohnish basically explain his investing approach, which is very handy information. So that is why I thought I would pass that information on. But just if you want to watch the whole thing, it's like an hour long. Just go to YouTube and type in Mohnish Pabrai. Go to his YouTube channel. It's the first video that'll pop up. But pretty cool.
Yeah. Did you see the kid's name was, I think he was 21 years old. His name was Charlie Warren.
It's like Charlie Warren Oberman or something like that. Yeah. So clearly his parents are value investors. I think Mohnish actually knows his parents.
Talk about an investment his parents made. I mean, they must have thought, okay, if one day he turns into an investor, then he'll be able to use this as leverage to get and to go and talk to them.
Yeah. Hey guys, just wondering, my name's Charlie Warren. Do you want to do an interview with me? He's like, what? This guy's name's Charlie Warren?
Get that guy on the phone.
Yeah, exactly. Pretty funny, but good work, Charlie Warren. Charlie Warren Oberman or Oberland or something like that. I'm not quite sure.
Should we do some Q&A?
Right, should we rattle off a couple of Q&As?
Yes.
Real quick.
All right.
I'm going to hit you with one.
Ooh, okay.
What are your thoughts on buying an ETF like Asia on the ASX, which, is exposed to Asian stocks, has about 10% in Alibaba? What are your thoughts on Asian ETFs?
I don't know about that ETF specifically, so I can't speak to that. I've never looked at that, so I don't know about that. But I think it's reasonable to have investments broadly in emerging markets. I think it's probably something I'll do relatively soon. It's just not something I've done up until now. But yeah, I mean, that's your alternative to investing in an individual business. If you're concerned about, risks around individual businesses in China, for example, but you want exposure to Chinese businesses, then you can do that through, maybe you could do something like an emerging markets ETF, or even just going through for something like a global ETF. And within that global ETF, you'll mostly be getting the US and then the other major economies, but you'll get a small slice of not just China, but other emerging markets that are going to continue to grow. I think that's a reasonable way to, like, my overall overarching principle is, if I don't understand something, but I believe that I should be invested in that space, then I go for diversification. So in stocks, I'm very comfortable. I understand what I'm doing when it comes to individual businesses. So I'm happy to have most of my portfolio in individual picks. But if I was to go emerging markets, I would go ETF. That would be my approach for other asset classes as well.
Yep. No, I don't think I have much to add. I think that Warren Buffett quote, diversification is protection against ignorance. I mean, if you don't have, and that's not trying to put anyone down by saying that, but if you feel like you want to be exposed to something in general, but you don't feel as though you have the competency to pick the winners in that space, then exactly what you say, just diversify across it. So if, we're not obviously telling you to invest in anything, but if you feel as though you wanted exposure to emerging markets, then yeah, for sure. But you feel like maybe you don't live there, or maybe you haven't done your research on CCP or that sort of thing, then yeah, just a viable way of still getting exposure there is through diversified ETF in the emerging market space. So yeah, I agree with everything you said. Everything you said.
Very good. I'll ask you one. Do you want this one? This last one?
Yeah, sure.
When you have limited time, how do you prioritize your research?
Yeah, this is an interesting question, because there are definitely shortcuts you can take. For example, I might pull up QuickFS and I might look at, 10-year compound annual growth rate of, the revenue and the earnings per share and the free cash flow and that sort of stuff, just to kind of get a feel for whether this company's going in the right direction, whether I would be interested. You can do things quickly, like see how much debt they've got, what are their debt ratios and that sort of thing. But I think an important thing to realize and be comfortable with is, if you have very limited time, I guess investing in individual businesses is not something that you want to rush. So I would say, maybe if you're someone that literally works 5 or 6 days a week, long days, big hours, then first thing I would say is, like, is picking individual stocks actually going to be something that is going to be viable? And maybe it is. Maybe you just spend a lot of weekends chipping away at it. But I feel like when it comes to picking individual stocks or trying to buy into businesses, you really need to put the hours in to really understand the business. And if you feel as though you can't put in the hours to keep up with it, to understand it in depth, then maybe passive investing is more of a way to go. But having said that, to definitely save time at the start of the process, you can do kind of quick screens. Like QuickFS is a good one. You can get a very good understanding of kind of where the company is and where it's going just by having a look at some of those growth rates and the return on invested capital and the debt ratios and that sort of thing. I don't know. What are your thoughts on this?
Yeah, I think that was. I agree with everything.
Is that
you
fair?
said. Yeah, I agree with that,
Okay.
and I think. I mean, one way you can prioritize is, what you said, go kind of the passive route. If you just don't have the time, if you have a full-time job and you have a family and you have other obligations or things you want to do. But if investing is a passion for you, right, then maybe that is something you still want to spend time on, then, you can go like 80% passive and just a little bit individual businesses. I mean, I even tell people when they're just getting started completely that just focus on one company, right? And don't make one company 100% of your portfolio, but, have maybe 98% of your portfolio in passive investments. And then you can put 2 to 5 to 10% in one stock, right? And that way you can prioritize your time on just finding one individual business. And when you do, you're not going to be, not all your money is in one investment. You have your passive investments, that's most of your portfolio, but you have a little bit overexposure to this one business that you're passionate about and that you've done your research and you think is a good deal. But yeah, I agree with you. I think using QuickFS to do that, and I think over time you kind of just naturally learn how to speed up the process. But most of the information you'll want is going to be in annual reports, from my experience. So learning how to skim annual reports and focus on the key areas, I think is something you kind of just have to practice and get good at doing. But once you do, then you can fly through annual reports. You can quickly get to the management analysis section and read that for the past 10 years in less than an hour. And that way you get a good understanding of, okay, this is what this company went through, what its factors were, what drove its growth. And that'll help you accelerate how quickly you learn about a business.
Yeah. Very good.
All right.
Yeah, Dunchkies. That was good. And the cricket started half an hour early, so there you go. It actually wasn't David Warner that got out. It was Marcus Harris.
Oh. Yeah.
That's all right. I've had it on in the background.
God damn it. I knew you were distracted today. No, I'm just kidding.
No, I like look at it and then I'll put a tab over the top of it so I can't see it for a while. But anyway, guys, that will do us for today. Thanks very much for tuning in, as always. That was a pretty interesting week of news. So thanks, Hamish, for joining me as always, and thanks for talking through some of those stories. Thanks. Very interesting. And thanks, guys. Just a quick reminder: if you do have a question you'd like to ask us for the podcast, then just go to the YouTube version of the podcast, find our most recent upload, and drop us a question in the comments section, and we'll take them, drag them into our Google Doc, and we'll go through them one by one. So we'll, if that's of interest to you, then go ahead and leave us a comment or question. But that'll just about do us for today, guys. Thanks very much for listening. Thanks to Sharesight, as always, for sponsoring. And we'll see you guys next week.
See you guys.